Hello, and welcome back to Alpha Finance, where money mindset meets financial strategy. So today I'm going to be reacting to another video from CNBC called Why Fast Food Has Gotten So Expensive. So let's go ahead and play the video.
Big and tasty. For just $1, you did your thing, dog.
Remember the dollar menu? Well, you may be hard-pressed to find any fast food item that actually costs $1 anymore.
$17 for 3 filet of fishes at McDonald's? Are you kidding me?
I don't have the money to buy fast food anymore.
Would you just miss the days when fast food was actually cheap?
When looking at fast food menus nationally, here are the average prices for fries.
Oh, I was about to guess that. $4 for a fry. I remember when I used to work at McDonald's. This was over 10 years ago at this point, but I used to be an employee at McDonald's. And I remember that when you used to go on break, they used to give you up to $10 to get whatever you want. And you could get like a medium fry, a six-piece nugget, a medium drink, and a McDouble for like $10. Whereas now the fry is, like it says on the screen, the fry is $3 or $4. Six-piece nugget is $4 or $5. How do you deal with that?
From McDonald's, a Happy Meal, and a burger combo from Burger King. But I paid even more than that. Here are the prices at fast food locations by the NBC offices in Midtown Manhattan.
Broadly speaking, sales are performing much stronger than foot traffic, and that's due in part to higher prices.
The Consumer Price Index measures inflation, or the average increase in prices over time. Fast food falls into the limited service meals category. Think anything that's typically ordered at a counter and taken to go. From 2019 to 2023, prices in this category are up nearly 28%. That's more than full-service meals. Think sit-down restaurants with servers, which increased nearly 24%. And it's also more than overall inflation, which increased 19%. So why are fast food prices so high, and where will they go from here?
Can I please get a Titan turkey? Can I get a foot long?
Oh, I don't even talk about Subway's $5 footlongs that are no longer $5. A couple of months ago, Subway had raised the cost of their $5 footlongs to like $14, and they had blamed it all on inflation. And then they significantly lost customer traffic to their stores, and then so their C-suite got together and said, "Okay, well, we can't do this because people are just deciding not to buy it." And then they ended up decreasing the cost, I think, to about $6 or $7, which is still a lot more expensive, like 20% more expensive. But at least it doesn't look like price gouging from that point. It proves that they could lower prices if they wanted to, although there is some debate, or at least they're saying that it's pretty much a loss leader for them, that they actually lose money on the $5 footlongs, interestingly, and they make money off of the bundle, right? Getting you to buy chips and soda. It seems like the margins on chips and soda is a lot better than it is on meats and breads.
Yeah, just that.
Between 2022 and 2023, the cost of food, beverage, and packaging rose around 11% for both McDonald's and Chipotle. Still, as of late, labor is the main culprit.
Is about a third of the cost of the menu item. So even as those costs moderate, in many cases, and particularly given the laws that we're seeing in California and some of the other, minimum wage laws.
So he's referring to the minimum wage law that got passed earlier this year in California that said that fast food workers have to be paid at a minimum $20 an hour. He's saying that that's causing an increase in the prices of fast food there.
And just increases that are happening is that wage pressure remains elevated.
The fast food labor market became increasingly competitive for employers during the pandemic as companies struggled to fill their restaurants. In 2022, the number of employees in the limited service restaurant category were still below 2019 levels. During that same time, the number of limited service establishments grew by over 4%.
As things normalized after COVID, you still see a higher amount of job openings and less people coming in to fill.
I live right next to a McDonald's. They're hiring starting at 15, but it's $15 an hour. I mean, if you only worked at $15 an hour and that was your only job, that's 30 grand a year. That's not really attractive to most people.
Those jobs.
Compared to 2019, the percentage of sales that goes towards paying for labor has grown for many limited service restaurants like Wendy's and Shake Shack, where it has actually decreased for restaurants like the Cheesecake Factory and Darden Restaurants, which owns chains like Olive Garden, Longhorn Steakhouse, and the Capitol Grill.
In order to maintain the same service levels and expand their operating hours to accommodate the consumers' late night snack demands and demands for earlier breakfast, fast food restaurants need to hire more labor across the day part. And so as they're competing with other potential employers, they need to make the job more enticing. And the easiest way to do that is by raising the wage rate.
And companies are passing these costs on to the customer, especially as states like California have raised the minimum wage for workers.
And obviously, despite this huge wage inflation, there's a lot of other factors at play. I think when you look at inflation within limited service, first of all, you're starting with a lower check average. And so any increase of $1 or $2 that an operator passes on, just by definition, has a higher percentage increase on it.
From December 2023 to February 2024, the national average for a quick service restaurant check was about $18, which is 4.5% more than the same time period last year. That's a higher percentage increase than both casual and fine dining. And full-service restaurants are capitalizing on the decreasing price gap.
Well, I mean, here's the thing. Nobody is going to go to if I get $15 or $20 to spend, am I really going to for just me to eat? Am I really going to go to McDonald's or am I going to go to a place like Chili's? Am I going to go to a competitor that maybe offers a better burger that's still going to cost me $15, $20? Maybe I go to Red Robin, or maybe I go to Shake Shack, like they said in the video. Or maybe I go to, if you're from the East Coast, like Fuddruckers or Johnny Rocket, or a place that definitely has just much better burgers. Like, what does McDonald's expect? And what they're seeing is, apart from this whole thing that has happened over the last week or two with the E. coli outbreak and their stock going down because of that, they've been seeing a decrease in foot traffic to their stores because people are just not going to pay $15 to $20 just to eat for one person at McDonald's.
How is this Chili's 3 for me only $10.99 when fast food is so expensive?
It could be because we don't have to pay for any mascots.
Please! I was born for this!
It has created a shift in fast food consumer behavior.
Perhaps before they were going there 10 times, but now they're still only spending $100 and maybe they're going there 8 times or 7 times, right? And so you start to see this traffic fall off because they're still spending essentially the same amount, but they're now going less frequently.
Although prices for fast food have soared, sales have remained strong. McDonald's, Wendy's, and Yum Brands, which owns KFC, Pizza Hut, and Taco Bell, have all seen revenue surge past pre-pandemic levels.
You can buy stock in McDonald's and Yum Brands, by the way. I don't know about Wendy's.
A lot of the sales are still going up, and a lot of that's driven by price as opposed to frequency or visits.
A lot of investors are now focused on who is best positioned to drive growth based on volume, because you can obviously only push your price higher for so long.
Yeah, I mean, so what they're saying is that price action is inelastic for these customers, right? Meaning that just because you increase the cost of your burger by 20 or 30% doesn't mean that the people who most buy that burger are making 20 or 30% more, that they'd be willing to pay 20 or 30% more. They're just not. They're going to spend the same amount that they've always spent, and when they're out of money, they're out of money.
And that for so long may have arrived. McDonald's missed earnings estimates in the first quarter of 2024, and an Evercore analyst called it one of the most sobering quarters for the fast food giant.
See, this is what I was referring to earlier, that McDonald's is having a bad year.
Others like KFC and Pizza Hut are experiencing the same consumer pullback.
We must be laser focused on affordability, which means good entry-level price points available every day. In the markets where we're doing this well, the business is outperforming. In some markets, however, it's clear we still have opportunities to strengthen our proposition.
100K plus income household are really powering through and still spending at kind of normalized levels. Where we see a lot of the constraint or perhaps behavioral changes is the 50K and below consumer. And so your lower end consumer who just doesn't have enough spending power to keep doing everything that they were doing when the economy had a lot of additional COVID stimulus available.
McDonald's has been trying to do this in the States, where they noticed this problem that they were having this year, and they implemented like a $5 meal. I don't know if you guys have seen that, where you can get a lot of the smaller items that you normally would not be able to get for $5 if you bought them all individually. You can get them for $5 if you purchase them as a group. Now, McDonald's is subsidizing the cost of that food. They cannot continue to have that $5 offering at $5. It's what's known as a loss leader. So they lose money every time they sell it. So that's not going to be a permanent fix to their problem of consumers leaving to go either to better food options or deciding that they're just going to try to cut back from fast food entirely.
Remember the $5 footlong at Subway? Well, that's a thing of the past. This turkey sub cost me over $11. The bad news about inflation is prices aren't going to go down. The good news is the increases are slowing.
They can go down if people stop buying the stuff. And Subway learned this the hard way.
Prices in general across the economy very rarely ever come down once they've been reset higher. One of the reasons for that is wages, once they're reset higher, very rarely get pushed back down and reset lower.
To combat the decrease in value offered by fast food, chains are relying on apps and loyalty programs. In its 2023 fourth quarter earnings call, Wendy's says that it plans to invest approximately $15 million, primarily in 2024, to further enhance its mobile app experience. McDonald's announced its goal to expand its loyalty program from 150 million to 250 million 90-day active users by 2027.
If you are one of these people who is an active frequent at McDonald's and it's starting to hurt your wallet, definitely try the app. I think they have like daily deals on there that actually make things within the realm of affordability. Of course, even with the app, prices still not going to go back down to where they were. But that's the thing about inflation. Like everybody wants to say that, oh, we've claimed victory over inflation because inflation is low. But people think that low inflation means low prices. No, high inflation means high prices. But low inflation doesn't mean low prices. It just means that the rate of price increases is lower. So prices are going to stay where they are. They're just not going to keep climbing as fast as they have over the past couple of years. But of course, people don't want to hear that, and that's not helpful.
They haven't been able to do before is have targeted advertisements that go directly to consumers based on their consumption preferences. And the companies will be able to see almost in real time the return on investment of those advertisements and those promotions that they push to the consumer, because they can tell, I pushed them the promotion on Tuesday and they made a purchase on Wednesday or on Thursday.
The value offered by fast food is something that customers will continue to evaluate each time they make a purchase, and it may ultimately determine how the industry reacts going forward.
Restaurants still take dollars to the bank, not consumer visits. And as long as they're able to continue to drive growth from a value or from a dollar perspective, I think, that's still good news for the industry.
Hey guys, and that's the end of the video. Thanks. I appreciate you watching, and I'll see you in the next video.